Hello all, welcome to Sand Compounding. This is Sandeep Anand. I'm starting a new series called 20 for 2030. And what does that even mean? For investors in investing, the formula of compounding, which is very powerful, and the formula is P into 1 plus R by 100 whole to the power N. And N is an exponential factor. N is nothing but, we all know, it's a time invested, time we invest in the capital is invested in a business, or the tenure as we can call. And the tenure or longevity of our investment is very important because if we make investments in businesses that can sustain for 10 to 12 years with a good level of growth and at the right valuation, we are made home. The returns on the capital invested would be very high. Now, how do we find businesses which can run and which has such longevity of 10 12 years, especially in today's world of disruption? Every business is getting disrupted. Erstwhile, no wonder Warren Buffett, the legendary investor, used to find businesses which are least disruptive and that can run for a long time with growth, and he called it as moat. While moat investing, I don't know if it's really that relevant in today's generation because all businesses are getting disrupted with the advent of digital and mobile and internet. Now, identifying such businesses is a very difficult task, and I have tried my best to find out 20 such businesses which can pay way till 2030, and come 2030, in hindsight, these businesses would have been great to hold for such a longevity period. Now, how do we find these businesses? I've applied the principle of inversion, which I learned from Charlie Munger, and we look forward to 2030, and when we look back in hindsight, the inversion principle, based on that, what businesses could and why those businesses could sustain till that period is what I've done. So here are such 20 stocks, and one most important thing, not in investing, not all businesses are great investments at all point of time, but most point of time. So there could be reasons being valuation is one important factor which can control the time when we enter into a business. If there are frothy valuations, our returns would be mediocre. So it's very important to identify great longevity, great businesses which has longevity, and at the same time that has good growth and the right valuation. So, but this could be a blueprint or a watch list that we can use to identify, and when the correction happens or recession happens, these great businesses could be a great entry point, could give a great entry point. Hope this gets interesting as we move on. So 2030 not only includes technology firms and the next decade growth companies, but also includes a lot of moat companies, what Warren Buffett would call as the moat, non-disruptive, strong branding companies as well. Now, one such company, what we have in the 2030, it's a great business. It's probably could be the oldest business in the American Stock Exchange, and that is nothing but the largest paint company in the world, which is Sherwin Williams. Sherwin Williams is part of 2030, and this has existed since 150 years and is still kicking growth. The last decade, Sherwin Williams has returned for shareholders roughly 10 times in 10 years, which is a significant compounder, and it has created immense wealth for shareholders over the past century. Sherwin Williams is in a very non-disruptive business. It's got deep distribution. It's involved in the manufacturing, distribution, and sale of paints, varnishes, coatings, and other related products. Sherwin Williams has got great management, and it's part of 2030 list. Let's analyze deep why it is part of 2030 list. So the analysis of Sherwin Williams, I've just brought in just few slides just to highlight the key points that needs to be taken care. I mean, there is deep analysis done beyond this, but then at the high level, what one needs to understand about this business and why it became part of 2030, and that's the reason why this analysis and slides have been prepared. So as said, Sherwin Williams is the largest paints company globally, and it's been there since 1866. Could be the oldest company in North America, and it would be one of the oldest that is listed, still thriving in the US stock market, and still kicking and creating huge value returns for the shareholders. It has created roughly 10 times returns even in the last 10 years if we take. So the illustration in the map, in the graph, shows that they have roughly multiplied 10 times, which is The price was $60. Now it's $579. And Sherwin Williams has a whopping 10 times returns in the last 10 years. So this doesn't mean that the next 10 years it's going to repeat the same returns, obviously, because the PE price earnings re-rating has already happened due to the bull market that's prevailing. But still, over the next 10 to 12 to 14 years, this could repeat. Now that's why it is part of the business for 2030 and even beyond. It's one of the least disruptive business that is existing today. And the disruption in terms of such kind of legacy businesses is usually less impactful. Sherwin Williams especially has the largest market share in paints and coatings business. They have roughly 4,700 stores globally, and they have presence across around 175 countries. Now they have three pillars of operating product segments. So starting with Americas group, that comprises exterior and interior paints, coatings, primers, top coats, aerosols. That forms 55% of the revenue. So half of the revenue is falling from the Americas group. Then there are consumer brands like Sherwin Williams, Valspar, Purdy, Krylon, that form 16% of revenues. Some of them are like Valspar are inorganic acquisitions they did and led to the inorganic growth. And the last segments of performance coatings, that forms 29% of revenues. They have been successful because of the solution driven approach for customers, directly working with customers in many distribution channels and through deep distribution channels, which has long lasting partnership. So they are deeply entrenched into the paints and the coatings and the varnishes business, and they have partnership with all the dealers across the globe. They have partnership in the with the distribution channels and making customized solutions for household and industries. So which is great, and that precisely why they have such a strong brand value. It's more than a century old, 1.5 century old, sheer leadership in the paint segment, just because of the brand value and the relationship, and that has created the moat. So the graph can show that how much market share that the top 10 suppliers of the paints market in the global market has. So the top 10 suppliers almost control 55% of the total market share, and that's huge. Now, in terms of the profitability, revenues, profitability, and segment-wise analysis, Sherwin Williams reported revenue of $17.5 billion in 2018, still growing at a good steady clip of 5%. They have high gross margins, which is leading to the cash flows and bottom line growth. Their operating margins are also very high at around 14.5%. They made an operating profit of $2.5 billion in last year and net profits of $1.7 billion in 2018. So clocking a net margin of 10%. 10% profit margin is significant for such a legacy and large business. They're targeting to reduce the working capital cycle as percentage of sales to 11.5% in next 1 year, and hence improve cash conversion cycle as well. So the management is really focused on controlling the operating parameters to achieve better cash flow as well as better cash conversion. They have steady free cash flow as a result of this, and planning to have around 11% of sales flow into free cash flows. That's a good target to have. With respect to balance sheet strength and ratios, I mean, we don't have to really go in depth in this. They have been existing. The management has proved this over and again, and so they have around good liquidity available of $2.7 billion. They have a debt of $9.8 billion, which is only 3.5 times to the operating cash flow. That's not very high, and operating cash flow is around $2.8 billion. So now they are valued at 39 times forward looking is high that way, as that's what I said in the starting of the slide. They have returned quite well in the last 10 years, and hence a re-rating has happened due to the bullish market. So they are trading at 39 times forward looking, and but they have excellent return ratios. ROE is at the return on equity at 36%. Strong balance sheet and strong management that way. So the growth prospects Growth prospects, considering the market capitalization of around $53 billion, and growing steady at 10 to 12 percentage on operating side, they are returning good cash and generating the cash and redeploying them. As long as the housing market and industrial business segments grow, they will continue to grow at good pace. Again, globally, it all depends on if there is a recession that can stagnate for 2-3 years, the growth could slow down. But if you take a decade long view, or a decade and a half long view, this business is going to exist at that point of time. Now expect them to grow around 5% over next 2-3 years, and corresponding EPS growth target of around 11 to 14% depending on the operating metrics. And they did well inorganic as well by through synergizing similar business acquisitions. They integrated 21 businesses in last 10 years, which is again important. For their size, they have to look inorganic as well for the growth prospects. They've created 5-year net operating cash of $7.7 billion from 2014 to 18, which is a significant value addition, and paid handsome dividends also. Now, a quick gist of why I think Sherwin Williams would have been a great business when we look back in 2030. It's a typical Warren Buffett mode type company with deep distribution, marketing, and strong branding. Leadership in the paint segments. In fact, globally, it's the largest paints distributor in globally, and less chances of disruption in the paint industry. Although cannot be ruled out completely, though anything could happen. But the chances of disruption is less compared to the other industry in business and industries. Now, steady growth with the real estate, commercial buildings growth in US and other countries they are operating in, and if they can penetrate into emerging and developing nations, that will be a great value addition for their prospective growth. High returns business with strong returns ratios on operating assets and equity. A great business where there is free cash flow, management is prudent about what they do with the cash flows, and steadily reinvesting the cash they are generating and plowing back into the business for future prospective growth is a great way to create value. They are steadily paying out dividends for shareholders, largest market share globally, and management still focused on organic and inorganic growth aspects. Most important is their deeply entrenched relations with distributors, customers, making customized solutions, and that's creating the moat. So this is a great business. I think one can blindly trust on for the next 10 to 15 years based on the prevailing parameters. Now anything could change in the future, and valuations are high obviously at the peak of bull market currently, but a great business and less disruptive that way to hold. Hope this was helpful.